Hello everybody, welcome to a new RRG video on Monday the 26th of May. My name is Julius de Kempenaer and I'm talking to you from Amsterdam in the Netherlands. Today is a holiday in the US, markets are closed for Memorial Day. And so for all of you who have served and all of you who are still on active duty, thank you for your service. The markets were again eventful last week. Overall, we saw a decline of somewhere in the range of 2 to 2.5%, depending on what index you're looking at. I've been calling for some weakness for some time, so this 2% is not going to cut it. But I want to look at what's happening in sector rotation and whether the events of the last, not just last week, but the weeks before, including last week, are causing any changes in the rotational picture for sectors. Maybe take a look at asset allocation and possibly looking at how the US is positioned in the international landscape of stock market indices. Here is the RRG for US sectors, and we still see the high concentration of sectors on the right-hand side of the RRG, and only two sectors on the left-hand side. And as you know, on the right-hand side is positive, those are in relative uptrends, and on the left-hand side is negative, those sectors are in relative downtrends. But also the trajectory and the heading of those tails is important. And there you see an improvement for technology and consumer discretionary. As you know, the two largest and most important sectors in the US, cyclical sectors, very cyclical. But also on the right-hand side, you see quite a few sectors rotating to a negative heading, to a heading in that southwestern direction. And we're talking energy, healthcare, communication services, financials, real estate. The only sectors that are not there yet are industrials and utilities and staples. Utilities and staples being very defensive sectors with the highest RS ratio readings. And on the other hand, I said consumer discretionary and technology, those are very offensive sectors, and they are picking up their heading, positive heading. So still pretty contradictory picture, I've got to say. If we swap this to the daily version of this chart, we see almost the opposite. We see discretionary and technology on the right-hand side, relative uptrends, including industrials. That's the yellow one, that's just right here. But they're not on negative headings. Their industrials may be, but discretionary and technology are almost moving due south. And then if you look inside the lagging quadrant, that's where most of the sectors are, you see healthcare, staples, utilities, and they're all picking up. They're picking up momentum after a rotation through lagging. And then real estate and financials are continuing, materials as well. And then probably the weakest from a rotational picture on this daily chart is energy, which is rotating back down towards the lagging quadrant. So what does this mean for the market as a whole? What can we find? Well, I'm afraid not much, because there is so much contradicting rotation between the weekly and the daily that it is very hard to find a common trend. Very often you will find, when you look at RRGs, you will find a common denominator where all cyclical sectors are moving in one direction, all defensive sectors are moving in one direction, or quite a few daily tails are confirming the rotation on the weekly RRG. So both tails are moving in symmetry or in the same direction. That's not the case right now. So it makes it confusing, maybe not the right word, but it's not coherent. And that is something that is hard when you try to make market analysis. You're looking for different pieces of the puzzle that fit together. And this weekly and this daily RRG, they don't fit nicely together. What I do see is under the hood improvement for the technology sector, and to a degree for consumer discretionary. We're not there yet, at least. Well, let me get this a little bit more granular. When I look at the RRGs And I'll do it again. Here's the technology sector moving lower. And when I move to the weekly chart and I look at the technology sector, it's moving in that direction. So that loss of momentum on the daily is, with a reading this low, I gotta keep the option open, or keep an open mind to the possibility that the technology sector will start to lose because of that loss on the daily. It will trickle through on the weekly at a later stage. And because it's so far to the left, there's plenty of room for technology to roll over and roll back into the lagging quadrant. Pretty much the same for consumer discretionary. Look at consumer discretionary, you'll see that the consumer discretionary sector here has already started to roll over. So it's in a similar position. The daily and the weekly tails are not confirming each other. So the big question is whether these two tails are now leading the way for those weeklies to make it all the way back into the leading quadrant, or was this just a little hiccup, and will we see those weekly tails for technology and discretionary roll over and back into lagging? It's very hard to say, at least when you're just reading the RRG like we do here. I can sort of give a hint, and maybe it's going to cause even more confusion. When you follow my blog articles on the best 5 sectors, where I use a hard ranking for sectors on a weekly basis, and I do that combining readings from the daily and the weekly RRGs, just hard numbers. There's no interpretation there. And after I finish this video, I'm going to write a new blog article on the best 5 sectors. And lo and behold, the technology sector, despite last week's weakness, the technology sector has moved into the top 5, and it has pushed consumer staples out of the top 5. Now, I have no idea how long that's going to last, because this could change next week. But I think it's interesting, and we've got to keep it in mind that this daily move on technology and discretionary apparently is strong enough to move those sectors up in the ranking. Just I need to process that and bring it into line with whatever I see. And right now I have a hard time seeing those weekly tails making it all the way through. But maybe the algorithm or the calculations I use there are right, and you don't need any human interference and just go with the numbers, because that has tested out as being a pretty okay strategy. Anyway, I think the message here is that the sector rotation is still not pointing into one general direction. There is definitely improvement under the hood for the more cyclical sectors, and that is what we've seen happening in the chart of the S&P last week and the weeks before.
If you're watching me talk about RRG on the Stockcharts TV channel and you cannot replicate it, that is because you are not a member yet. If you like what you see and you would like to have the same functionality as what I'm using in my videos, at least take a free trial, check out the functionalities of RRG, and after that, we'd love to see you as a subscriber to our service.
When we take a look at the weekly chart of SPY, we definitely see that strong V-shaped recovery move up, even with a runaway gap or a breakaway gap, depending on how you would classify this move here. But it's definitely above its previous high. We ran into some sort of resistance, and we're now dropping back because the close was right above this dashed line here, which is the upper boundary of that gap. So what I'm watching right now is whether this old resistance, now support level, is going to hold up as support, or do we dip further and will we see, this is 569, let's say 570, which is the lower boundary of the gap, or maybe even the old rising resistance line, which is around 560. Nevertheless, that lower lows, lower highs has been broken. So we are now witnessing, or we will witness, the first corrective move. And it's going to be very important to find out where that move is going to stop and where that new low is going to be made. And given the size of that move, I'm sort of inclined to say that's going to be a new higher low, but that might be speculation. But the odds are in place for a new low to come in at a higher level than the previous low. So a shift of gears, a shift of maybe not regime, but definitely a shift of gears on the weekly chart, looking for upside now. And that has changed. We were looking for downside. We're now looking for upside, with the downside coming in at support levels. Now here is the S&P chart, or the SPY chart, on a daily basis, and you see it a little bit more granular. Very nicely lining up of this low here in January 25, then a little bit of a cluster here when it broke down in March, tested as resistance at the end of March, and then the gap up, which gapped above that previous high on the 12th of May, and then we peaked against this low and this cluster here. There's a cluster here around, let's round it off at 597.5, 595, 597.5. We're coming down now, and we are testing the old resistance area as support. So was last week's low the low, or do we see a little bit more downside? The case is that this is a very clear series of higher highs and higher lows on the daily chart. It has emerged into higher highs, higher lows on the weekly chart. So I'm going to call this a new corrective move, and we're looking for a new lower high to come in place anywhere between 570 and 575. It's a little lower, 568. In this area, in this gap area or above it. The higher the low comes into place, the stronger it is for the market. That's reading straight from the SPY chart. That type of analysis means that we've got to pay attention, probably more attention, to the rotation, the strong rotation of at least tech and consumer discretionary, but also more other cyclical sectors like industrials and materials. That's my take on current sector rotation and SPY. And let's take a look on how that plays out when you take it one step up to asset allocation level. Here's the asset allocation RRG I use for this purpose. And we see SPY on the left-hand side almost crossing into the improving quadrant. And pretty much all other sectors, this is the US dollar index, on the right-hand side. And we see opposite rotations for high yield corporates and government bonds rotating out of favor inside leading, SPY rotating back into favor into the lagging, inside the lagging quadrant, almost inside improving. When I swap that to daily, again, you see the opposite. You see SPY inside leading, but moving straight down, and you see the fixed income related asset classes moving up. It's kind of a similar situation as we have seen on the sector rotation, on the sector level. So again here, also from an asset allocation perspective, not yet a fully backed up, synchronized improvement for stocks, for SPY. But there is definitely something going on. And the big question, and I think we're going to see the answer either this week, or I'm going to give it a max of 3 weeks to see whether, if we stick with the asset allocation, whether this SPY tail on the daily RRG will rotate back up and confirm the strength that we see on the weekly, or whether this SPY tail will rotate back into the lagging quadrant, causing that weekly SPY tail to roll over and back to the lagging quadrant and continuing its relative downtrend versus VBINX, because that is the benchmark that we're using here. So from an asset allocation perspective, also no confirmation for stocks being the strongest asset class, but there is definitely improvement visible under the hood. I think the biggest problem in both cases, for sectors as well as asset class rotation, is the speed of the movements. The trends that the RRGs measure need, let me put it the other way around. RRG needs a more pronounced and a longer established relative trend before it picks it up. This move was so fast that it wasn't picked up. It happens. We deal with it. Anyway, cyclical sectors seem to be on the move. Stocks seem to be on the move, but we do need more confirmation, and I expect that to happen in the next 2 to 3 weeks. Let's wrap this up with a look on a relative rotation graph on how US stocks are positioned versus, let's say, the rest of the world. These are a number of major stock market indices, and it's a weekly RRG. If I single out the S&P, we're right here. It's inside the lagging quadrant, starting to pick up relative momentum, but it hasn't picked up relative strength yet. If you look at other tails, they're longer and they're stronger, but they're already starting to roll over. So this is Brazil, this is Mexico, this is Europe, this is Hong Kong, this is China, this is Korea. Australia is picking up. It's in a strong move, just like the Indonesian market. The Nikkei Japan seems to be in the same boat with the S&P 500. So these markets that you see with these long tails and rolling over, they have led the international stock market indices over the last 5 to 10 weeks, probably. If we switch this to a daily RRG, we see again almost the opposite. Here's the S&P 500. It's pushing into leading, but not a lot of momentum. It's picking up on the relative strength scale. It's picking up on the RS ratio scale, but there's not a lot of momentum there. And the momentum is stable. The momentum is not increasing. So it's okay, but it's not great. If you look at, for example, the Indonesian market, that's really strong, surprisingly strong. And if you look at Hong Kong, that's picking up. It's just 1 day of momentum loss. But remember that Hong Kong tail, way inside the weakening, plenty of room to curl back up again. And then the whole cluster of all these markets inside lagging and crossing over into improving, except for the Nikkei. Nikkei is on a negative route here. But all the others are picking up momentum again. So just like what we had with the sectors and the asset allocation, with non-confirmation between the dailies and the weeklies, we see a similar pattern here on international stock markets, driven by the US, which is not a surprise because it's the largest portion of that Dow Jones World Index that we use as a benchmark here. Nevertheless, we've looked at 3 different versions of RRGs. We've looked at both the weeklies and the dailies for all 3 relative rotation graphs. And the only conclusion that we can be certain of is that they are not complementing each other. They're opposing, they're showing opposing rotations for the better part of it. And that keeps me on my toes. It makes me very alert on what's going to happen. And I think with this type of constellation, we would see confirmation on either side within the next 2 to 3 weeks. And that will help us to build a longer term plan and get a better view for, let's say, a new 3 to 6 month trend when it emerges. So wrapping it up, still opposing rotations, asset class level, on sector level, as well as international markets. However, improvements under the hood, especially on the sector level for the more cyclical sectors. And when I peek to my best 5 sectors algorithm and I see that tech is squeezing into the top 5, I know that it's something I need to pay attention to. And as I said, probably the next 2 to 3 weeks will give us more answers. Thank you for watching. I hope you enjoyed the show. And as usual, leave your comments below the video so we can have a chat there. Looking forward to seeing you again at a new video for RRGs here on Stockcharts Television.